Good afternoon. I'm Per von Zelowitz, the director of the New York Innovation Center at the New York Fed, and welcome to the Fireside chat on tokenization and smart contracts. We've really benefited from some fantastic discussion throughout the morning on similar topics, and we're focusing during this Fireside chat on trying to get a bit deeper into some specifics around examples where tokenization and smart contracts might be delivering value, or where there's still opportunity for these new technologies and new instruments to deliver value. Tokenization is the process of representing claims digitally on a programmable platform, but programmed with what? Programmed with smart contracts, which are self-executing applications that can trigger an action if a condition is met. Tokenization is a rapidly developing field. There's been a lot of experimentation in the private sector and across the BIS Innovation Hub and the New York Innovation Center in three broad areas: foreign exchange, securities, and tokenized deposits. Now, we've heard quite a bit about the unified ledger concept and also Project Agora during the day. Those are two practical examples of experimentation in this domain. We just heard about tokenized deposits and stablecoins from Umar and Dante in the previous session. And in this session, we'll focus more on financial markets and settlement. Now, throughout all the experimentation, there have been quite a few learnings that have been generated so far, a lot of data. And in general, the experiments indicate that tokenization is feasible and has potential. But where is the potential specifically? And how do we best collaborate to realize this potential? To collaborate, there are roles for central banks, commercial banks, non-bank financial institutions, and financial infrastructure and technology providers. On this panel, we're very fortunate to have representatives from a commercial bank and a technology firm, as well as a lot of central bankers in the room to provide another perspective. First, we will explore where innovation is generating progress, and then focus on how we can collaborate to continue the progress. So I'm delighted to introduce Stella Lim, who is the COO of Partior. And apart from leading Partior's global partnerships and operations, she oversees a wide range of critical functions, including business development, customer onboarding, government affairs, and communications and marketing. Prior to joining Partior, Stella was with Swift for 14 years, most recently as the managing director for Swift in the Asia-Pacific region. Prior to her role at Swift, Stella held senior positions in information technology and banking, including roles at organizations such as SmartStream Technologies, Internet Security Systems, Nettic.com, and Deloitte. I'm also delighted to welcome Xiaonan Zhu, Head of Innovation and Digital Assets at UBS. Xiaonan is the Head of Innovation and Digital Assets at UBS Group Treasury, where she drives digital asset strategy and leads the institutional adoption of digital assets globally. Her deliveries have spread across capital markets, treasury and transaction banking within the fields of CBDC, digital bond issuance, digital cash, and digital collateral trading. Xiaonan represents UBS in fintech, digital assets, and CBDC collaborations with central banks, fintech companies, peer banks, custodians, and exchanges. And she is also on the board of the Corda Blockchain Network Foundation. And now to get into the questions and the discussion. When we talk about potential for these technologies, this really has two sides to discuss. First, what the technology can do. Practically, what is the potential of the technology? And are there characteristics of this technology that are advantageous relative to the current state and legacy technologies? And second, where are the opportunities to improve how we do things today, and what are the challenges? Is it especially suitable for particular use cases or in general? We already heard a lot about tokenized private money, so going a bit wider, what are the unique technical characteristics of tokenization that could benefit financial markets and settlement? In which markets or asset classes might tokenization deliver the most significant value proposition? Why? And what do we miss if we do not have tokenized assets? So I'll start with Stella. In which areas beyond money that was already discussed in the previous session do you see the technology having the most potential benefits and why? Can you please provide some specific examples?
Yeah, thanks, Per. First of all, it's a real pleasure to be here. I think there's no doubt that we have heard the whole day the conversations and also by various different central banks and countries, and also in the previous sessions on technology benefits that it can bring to tokenizations. So when you go deep down into it, there are a lot of characteristics in tokenizations where it's programmed by smart contracts. So in smart contracts where you see the programmability, immutability, composability, atomic settlements that is making all this process happen. In the current traditional world where you have the transactions that is being facilitated by multiple intermediaries and institutions across messaging separately, clearing and settlements, hence a whole delay in the process itself. So with the technology that has empowered the whole process end-to-end in one venue, it makes everything possible in terms of access into the liquidity itself. So traditionally, like the illiquid assets that is impossible, allows the investors to be able to get access to it in various different markets. It's a lot easier. So this helped a lot in assessing the business case of liquidity. So in Boston Consulting study, it has shows that the opportunity for real-world tokenizations will grow to 65 trillion by 2030. So this is a real benefits to the world looking into how financial services coming up with new different products to be offered to the markets, and also in terms of revenue generations for them. Another area to look at where technology has empowered is really a lot we talk about incorporates into smart contracts, the regulations, the rules, the compliance has made the whole process that it eliminates some of the admin process. But of course, in the earlier previous sessions, a lot has to be overcome in terms of challenges. How can this be monitored? How can this be mitigated in terms of the risk itself? So from there, you also need a really trusted market infrastructure to play the role with technology that can it will be interoperable. Because we spoke about unified ledger. It may be multiple unified ledger because each unified ledger carries its own different assets and purpose. And how do we interoperable with all these unified ledger together? Whether via API, it has to be an open standards and protocol where all the various different projects, we heard about BIS has now various different projects in many different countries. How do we get these different projects together? I believe that banks are all very, if I may be honest and open and direct, fatigued in all these POC and projects. It's a lot of budget resources to put into, but how can each project be able to be reusable? Reusable, and also it comes out from the project to graduate from sandbox and continue to commercialize and be able to use with it. So all this has to be powered by a roadmap of technology planning. Plus, institutions has different area of expertise. Some has better in terms of resources and budget to put into internal R&D center, but some will be relying on government support, central banks, in terms of public and private sector to come together to cooperate and coordinate together. So as we emerge from the smart contract, become a revolutionary technology, I think it's a lot also about the receptive of banks on how they can deploy the technology, internal risk policy, the appetite, how can they implement the technology to be a longer run.
Thank you, Stella. And now on to you, Xiaonan. When you think about the potential of tokenization and smart contracts, what are some of the frictions that exist today that tokenization and smart contracts could potentially solve for? And could you talk a little bit about the potential benefits?
Mm-hmm. Yes, certainly. And firstly, thanks very much for having me here. When it comes to the tokenization, there's a lot of benefits this technology can bring us. We know that the financial market today is making up with a fragmentation landscape of custodians as well as counterparty relationships. As a result, when we're moving securities as well as the collaterals across the globe, it is actually very expensive and it is actually prone to the settlement risk. On top of the fragmentation of the financial market, we also have the situation that when we're trying to settle a transaction, the security movement and the cash movement might not happen at the same time. So this fact that things are not happening simultaneously, creating the further risk and the further hurdles for us. This means that for large financial institutions, for example, we will have to put excessive buffers to make sure that we can have better certainty to settle a transaction. Sometimes we even have to put buffer on top of buffer to make us feel better. So it is really a good way to actually utilize very scarce financial resources and high quality liquid assets on our balance sheet. I don't think it's really a good deal. So what can we do? Here comes the tokenization. Tokenization promises us the simultaneous settlement of securities and cash. It also allows us to use a shared ledger to see everything at the same time across all the parties, across the transaction. So this really provides an opportunity to actually making things more synchronized. Using one example, actually back in 2019, we have already tokenized and executed a collateral swap with the help of a fintech vendor called HQLAX. So in that transaction, a basket of German government bonds and a basket of corporate bonds were tokenized, and the ownership were represented on the blockchain. The settlement of the security of the transaction is actually by simply updating the record of the ownership on blockchain. So it happens real time at the precise time that we wanted to settle, and there was no settlement risk. But we know that really having more setup like that, we need wider network effects. And this is probably something that will happen during the course of the years. But if I may, just to draw people's attention on something that a lower hanging fruit, I will certainly call everyone to looking into the intercompany transactions, because such transactions do not rely on the network effect. We can simply just using our own entities and infrastructure to adopt this technology and utilize it more widely. A good example I could also give is within our US entities today, we are already working together with our market infrastructure provider, Broadridge in this case. Using the tokenization technology, we were able to trace the collateral movement, and we were able to see in real time where the collateral is. So as a result, we can actually simplify the operating model and reduce the amount of accounts and the time we have to handle such transactions. So those use cases hopefully give us some example to show how the tokenization technology can actually be implemented in the financial world today already.
Thank you. And you both cited some great examples of where value is currently being realized using tokenization and potentially smart contracts, but also where the potential of it is. And one thing that I heard is there might be one way of separating the value proposition where there could be value created for internal purposes. So this could be operational value that's realized for an institution, or external value that might be realized by your customers and clients. And I wonder if you could expand a little bit on some of the examples you provided where you're seeing the bulk of the value today. Do you have a point of view on if there's a critical starting point for value creation that will really lead to the greater adoption of these technologies? So will internal lead or will external lead? And how do you see that playing out necessarily in the future? Stella?
Yeah, I believe it's a lot about collaborations, because we're talking about network density here. It has to scale. It's not just a few, it's not just for internal, but externally it has to come together in terms of cross collaborations. So it cannot work in silo. Silo can only be very domestic into the applications itself. So when it comes to collaborations, a lot of parties that come together where we ending in this room, the central banks, the financial institutions, the market infrastructure provider, and technology vendors like Partior, where everyone's come together to look into how can we scale the projects itself. And beside from technology perspective, there are a lot of discussions around the legal framework, around the regulatory framework, around the private sector's coordinations. How do we scale the projects itself to eventually have end visions? What do we want to do with it? Is it commercialize a project, or is that just research and testing? What do we want to do? I think with that, it will give a clear visions for each institution to make a decisions on how to budget the projects, to plan for the future roadmap into that perspective. So there are many considerations, and also geographically, each market has different maturity. So markets that are more prone to the digital transactions will have a better and quicker uptake of tokenizations. So this would actually benefit the markets of developed countries versus the developing markets that is being very cautious in terms of approach into looking into that.
Thank you. And just Xiaonan, if you have a brief follow-up on the prior question, just relative to where you're seeing the value internally or externally before we move on to the next question.
Yeah, certainly. I think it's very critical because the tokenization is a long journey and it's a marathon. We all coming together and try to break the silos and break fragmentation through Agora, through Unified Ledger, etc. But before we come into the end of the game and the perfect best future, we really need to think about how do we face ourselves and so we do not just lose the momentum. And how to do that? We can do this by starting from early and low-hanging fruit use case, like the one that I've just mentioned, because by doing such use case, we were able to quantify the liquidity saving by seeing how much high-quality liquid assets we freed up. We can monetize it for something else. We were able to, for example, quantify the hours of the labor cost from our back office and middle office. So all of those will package into a use case to persuade our senior management and the shareholders that this innovation journey is something that can not only bring us to the perfect future, but also bring us some medium to long-term benefits. It's not something that we will have to wait and a big risk we have to take, because no one wants to just take a risk and with just one word, okay, it might come in 10 years' time. We really need to see small things happening step by step. And that's why we think the collaboration internally, but also connectively with the network is very critical.
That's great. And I love the example of quantifying the problem and also quantifying the actual value that the solution has delivered. And it seems like we're at a critical juncture with a lot of these technologies, again, where there's been a huge amount of research and tremendous learnings from that research. But we're now focusing on the practical benefits and how do we really realize those benefits for whether it's internal or external use. And now we'll move on to the next question. And Stella, you started to touch on this earlier a bit. And a major challenge in technology adoption for banks and payment or settlement has been to generate some form of network effect. So effective change requires widespread coordination to ensure adoption at scale. I'm not sure we're seeing scale yet, but we're seeing adoption at points, and we can evaluate that data and those examples just as you were providing in a really useful way. So how can we as central banks, commercial banks, market infrastructure and tech firms collaborate to ensure this positive change? So I'll start with Xiaonan this time. So when banks are thinking about strategic technology investments, is tokenization really on the list? Where is it on the list? Is it at the top or somewhere else? And could you provide some more practical examples of effective collaboration driving adoption?
Yeah, certainly. So the innovation and the technology is very important for large financial institutions, or in this case for UBS as well. We not only have strategic investment into tokenization and other use cases and technologies, we also have the warm body on the ground, like myself and the team, to actually execute and deliver such vision. So when it comes to the collaboration, I think it is really a paramount. especially at this stage when tokenization is at the infancy. Why do I say that? Because the collaboration creates the common standard, the common rulebook, and that's make sure that when we create the different digital assets on different platforms, they will have the good liquidity, and the liquidity matters to everything. So this is really the guiding principle for a lot of things that we are experimenting today from the UBS Treasury digital assets perspective. An example of collaboration I can give you is back in 2022, when we were looking at the UBS digital bond experiment, we were thinking, okay, at that point of time, we have seen so many digital bonds launched. However, they were all merely private placement because they are launched on platforms that are only connected to itself, available to its own member banks. So we collaborated then with our fintech partner SDX in that case, and we encouraged them to work together with a traditional market infrastructure provider. So that yielded a great collaboration between the SDX and the Swiss exchange, SIX, and that created an operational bridge to allow UBS digital issuance, which was a 375 million OPCO bond, to be floating across both digital and traditional platform. So the bond is as liquid as a traditional bond and also acceptable for all the investors that who normally trade UBS bonds. So that is an example to show that collaboration within the private sector. You have a bank, you have a fintech, and you also have a market infrastructure provider. And then if we extend that example, we already heard earlier, Mr. Jordan mentioned Project Helvetia Phase 3, so that is also a perfect example to show when the central banks come into this collaboration with us, we can create a perfect settlement asset for a digital bond in a digital format. And this is really something that we all want to see one day. And maybe just to conclude with another more visionary case or example here. When we think about tokenization, we shouldn't just think about using tokenization for the short-term efficiency gain or cost saving. Obviously, that is very important, but how about more important things to the heart of our central bankers and regulators, and also ourselves? For example, the financial stability, the market resilience. We know that in the US, we are seeing the central clearing of US Treasury securities coming in the next couple of years. And one big reason that the regulator bringing this up is because we want to see less settlement risk in this most important market in the world. So the solution is a central clearing, but we also know that, okay, they did tokenization promise the same thing, i.e. they remove or reduce the clearing process and also making things more synchronized. So we've already showed ourselves that the UBS example, when we launched the digital bond, there was no clearing process, there was no trade matching process, because a digital bond natively issued on a blockchain by nature does not require matching, does not require bilateral clearing. So yes, we're using a different technology, but we are moving toward the same direction where the US regulators wanted to see for the Treasury market. So to conclude, I think the journey, again, is a marathon, and the best network effects need the collaboration across the central banks, the regulators, and the private sectors.
Thank you. That's a fantastic example. And I love the example of Helvetia, where it seems like it's a great use case of a progression from research now to something that's practical, and also a great example of collaboration between the public and private sector. And now, Stella, the same question for you. You're coming at this from a different perspective, from the perspective of a technology provider. So what role do you see for technology partners in driving collaboration?
Yeah, I think to echo what Xiaonan has mentioned earlier, a lot of initiatives that she has just mentioned is also in partnership with technology providers and partners. So this is the role where Partior is playing. Large institutions is probably able and affordable to build R&D team internally, or to work with technology partners like Partior, where we are blockchain powered market infrastructures to do cross-border clearing settlements and also PVP and DVPs in the roadmap itself. So when you come into the markets where you have various parties in the projects itself, central banks, the private institutions, and also market infrastructure. This is where technology partners can come in with live platforms and to power the projects itself rather than building from scratch. Because if you build from scratch, it's a lot of effort to go into starting the projects. All they need to do is leverage on the platform. What they have to do is then incorporate into all the other business considerations, legal, government support. It is more about coming back to collaborations to make the use case more scalable, and more participants of various different sizes and different markets is able to participate in an open protocol and standards itself. So I see this is where the technology partners in the markets can provide the benefits too.
Wonderful, thank you. And certainly from the perspective of the work that we've done in the New York Innovation Center, collaboration has been a key success factor for our work. We're delighted to be one of the collaborators on Project Agora as well. And now we have a little bit of time to open up for audience questions. So there's some microphones. So if you have questions, please raise your hand. And when you take the mic, please introduce yourself. So let us know who you are and then ask your question.
Hi there, can you hear me? Okay. Hi, this is Catherine Gu from Visa. Nice to meet you guys. I do want to go back to the debate between the public versus private chains, because increasingly what we're seeing is that the tokenization on the asset side is much more pro to going for the public chains, as we've seen with BlackRock, right, recently. But I think on the tokenization of deposits and tokenization of money in general, given different type of regulations, that remains to be more on the permission side. So I think this probably suggests a new type of fragmentation that could emerge with your assets versus your liquidity on different type of network. Do you think that will be an issue? Especially, I think you did touch on the atomicity of all these exchanges. Do you think that could create a new type of friction as we're looking to how, can do finality and settlement in real time? Thanks.
Yeah, I can quickly pick this up. So I think it's extremely important to understand the technology setup and interoperability in this case. And that's why we have been working for a very long time with technology providers as well as the market infrastructure provider. I think in the end, it's not just a technology setup, as previous panel have said as well. It is a legal setup, it's also a regulatory, and sometimes could be a geopolitics reason as well. Swiss National Bank, again, is quite pioneering in developing the pillars of central bank digital currency. And why I keep mentioning that, because for UBS, when we're looking at the central bank digital currency or digital money perspective, we don't just looking at, okay, one single protocol or one single setup. The project Helvetia actually allowed us to see that how a digital liquidity of central bank money with a traditional commercial bank money or traditional RTGS money can work together. Coming from the Treasury myself, I know that the intraday liquidity or liquidity is paramount. So how can we actually see the different liquidity across different boxes and across different protocols coming together, and to really manage them and create the transparency and the traceability is really crucial here. And when it's come back to the public and the private debate, I think this debate will exist forever, and the different people will have different preferences. But I think in the end, as a bank, our mission is to create the stability and to create the value for our clients. So that means we create the best product for our clients as well. So again, back to the example about UBS digital bond, we issued on a Corda blockchain powered by the SDX platform. The reason for the first bond, obviously, is very simple, that SDX is FINMA regulated. But apart from that, we also depends on the use case, because a UBS digital bond is not it's not like a public investment that the people will wake up tomorrow morning and say, why don't we buy a UBS digital bond? So because with the digital bond issued by a large institution has very targeted audience and professional investor. So back to the question again, when we look at the public or private, a different setup of technology, we need to be use case driven and commercial viability driven.
How do you see it from your operation role in UBS, the coexistence of CDBCs and tokenized deposits? Is this a big thing or something that will evolve in parallel over time, or do you see one over the other privileged?
It's a great question. Firstly, I think we're touching the two different types of money. Regardless it is a blockchain-powered or not blockchain-powered, central bank money is always the trust anchor of the monetary system. Today, we already have UBS money or commercial bank money, which is your deposit at UBS. So this means that when we're looking at the future of the money landscape, it is very important for us to observe and to explore how we can utilize the same technology to bring the liability of UBS onto the blockchain, and most importantly, to make it interoperable with central bank money. That means that if in the transaction banking or correspondent banking field, our money, if we were to utilize the blockchain, needs to be able to transferable with the digital coin or digital money issued by, for example, JP Morgan or Citigroup. But at the same time, the settlement of the large banks still needs the trust anchor money, which is the central bank money. So as a result, no matter it is a Swissy or it is the US dollar, the central bank money coming into the scope will really bring the whole ecosystem into a more regulated and more trusted stage.
Thank you. My name is Usman Mandeng with Accenture. Hello. I would like to ask, coming back to the interoperability, because my sense is that a lot is being talked about interoperability, but to me it's a little bit like a red herring. There is the possibility that we have various different chains, and of course we have various different systems. Today there is no interoperability between systems. They all operate in complete isolation, and the only way they communicate is via secure messages. There is no reason to believe that we couldn't replicate that for the blockchain world if we wanted to. But is interoperability really a problem? I mean, I can see in the future that, say, a bank like UBS is issuing on Solana, it's issuing on Ethereum, it's issuing on various chains. As long as these coins can flow back and forth, there is no reason why interoperability is actually a challenge in the first place. Could you comment on that, please?
Do you want? You can, yeah. I think, I believe interoperability is a very big topic itself. It's a very big topic because you wanted to make sure that the projects that you're implementing, like you just mentioned, on a different platform and also on-chain, off-chain, on the transactions itself, you wanted to make sure that they're synchronized. And if it is a financial institution that is operating, especially when they have a global footprint across various different markets, the interoperable of the transactions itself in various different markets has become very critical in order to make sure that the transactions can flow through and also be able to survive the different time zones, and also the trading windows itself. As you cut across from US all the way to Japan markets, the trading windows has become like smaller and smaller. And then you have all these settlements times that has been changed from T+2, T+1, and eventually the end vision of T+0. So it has become very important in terms of open standards. Right now, you're right, it's operate at a very silo environment, and some of the institutions or even like technology vendor are looking into providing the various different API, a standard API and global APIs that is able to link some of it together, not all entirely. It's still a long way, it's a road to go.
Yeah, I can only echo that. I think in today's transaction banking landscape, there's a different complexity. The reason a lot of large banks exist today is because we're providing this facility to allow that banks or small institutions that do not have the connectivity today to be able to make transaction. And such activity or such services is still prone to delays and prone to risk. and also is very costly, especially for the smaller players in a smaller jurisdiction. So that means that a interoperability one day, if can be created, could potentially mean less intermediaries and less large banks in the middle. Probably in today's world, when you have 10 intermediaries in the middle to make a transaction, in the future, if you have a better interoperability, you may only have 5. This immediately already reduce your costs and reduce the time that's to settle a transaction. So I think the interoperability matters a lot. It's not only a technology thing, it's also a business model where someone will need to give away some interest and someone will need to hurry up with their technology development.
I'd like to ask a follow-on question to that, where we heard earlier about the potential to enhance financial inclusion. And we've also heard some examples from larger financial institutions around the world that are benefiting from these technologies, investing in these technologies as well. And I wonder if you have a point of view on if tokenization is a benefit or a value proposition that's equally distributed across larger and smaller institutions, or equally distributed across geographies, or if there's really a different potential for these different types of institutions based on size or based on geography. And Stella, perhaps we could start with you.
I think the word's equal. It may not be equal in terms of the institution size. So the larger institutions will tend to have a better technology in terms of support their tokenization's journey within the organizations itself because of the global footprint that they are covering in multiple different markets. In terms of their revenue generations, the products that they can offer to the markets, where they can offer to their counterparty, the smaller institutions, their entities, they can have better access into the markets itself. So the smaller institutions will then get indirect or direct benefits from the larger institution in terms of partnership because tokenizations is a win-win partnership between the larger organizations and also the smaller organizations itself. However, in order to balance between the larger and smaller institutions, I think interoperable technology is very important to bring both of them together because the journey, the maturity of both organizations will be very different. So I think the struggle that the smaller institution or even some large institutions to deploy a new technology is very much because of the complexity to integrate into the current legacy systems. So this is where all the spaghetti and spider nets has come in and how they further improve to turn into 24/7. We talk about real-time, instantaneous and simultaneous settlements. It's 24/7, but it's not just technology. Are banks ready for 24/7 operations? So are they ready to support the different markets? Technology is there for them. Yeah.
So yeah, I would quickly add on that. I think when it's come to the smaller organizations compared with the large ones, sometimes I feel really jealous of them as well, the smaller ones, because they're more nimble. They can quickly adapt some new technologies, maybe faster than large organizations. Again, I think when it comes to innovation, I don't think it's a size-driven. I think, again, it's use case-driven and business model-driven. The smaller organization would have a different use case than us. And don't forget, it's not necessarily very expensive to start innovation because a lot of the fintech solutions actually not very expensive to start with. So as a smaller organization, is always encouraged to directly working with those most innovative fintech companies and create their own roadmap. I think that is a great way to show that the financial inclusion can start from the stage that when the smaller institutions can bring the innovation into their own hand and create more value and economic benefit to themselves and to their clients.
Thank you. I think we have time for one last question, if it's a quick one. Just over there.
Thank you. I wonder, what are your thoughts in terms of climate aspects of asset tokenization? Let's say you tokenize a green bond, right? And you use that end-to-end on-chain. What's the carbon footprint? And what's the requirement to the climate-related disclosure and to ISSB standard? Thank you.
Yeah, I think we actually have our colleagues from the HKMA who are probably better positioned to answer the green bond issuance because they have been doing great experiments in that space. But from the investor or the trading perspective, I think tokenization, digital bonds, is still at the infancy, let alone like a tokenized green bond. So it's required a lot of research into this space and also a lot of data to be collected to really prove the trade-off of the efficiency is created versus the carbon footprint is created. So I have to say, I don't have a definitive answer for you now, but hopefully next year when we come back to the BIS Innovation Summit, we will give you a dashboard.
Well, thank you for the insightful questions and the fantastic discussion. So please join me in thanking Xiaonan and Stella.